Hello, hello. Lululemon has been down 50% the last year, and I wanted to take a look because it's been going down and down, and the numbers of the company are really nice. And I wanted to discuss what's happening exactly so that we see whether it's a nice buy. It's mentioned a lot online as well. If you take a look at the P ratio, you'll see it has been heading down quite steeply, expectedly so because of the price going down, obviously, of the stock. And the earnings also going up, as you'll see here, like the revenue is going up and net income, of course. Net income is going up for the most part. And so the P ratio is going down and down, sitting at 12 right now. It used to be way extended, as you'll see here. This is never a place where we wanted to buy this company, even though there was hype. I think because of some leggings or something of that sort for a while. Now, outstanding shares going down also because the company is spending money now purchasing stock, which we're going to be taking a look at. They're buying back shares is interesting because with the stock price going down, they are saying to potential shareholders like, look, the stock is going down, it's great value, so we're buying back. The net income and total equity and free cash flow, look at all these, they are all of them going up. And the price to free cash flow, understandably so, obviously, similar to the P ratio, for the most part, it's going down, with the total liabilities of the company basically almost nothing, about 3 years of free cash flow in order to pay back all the total liabilities that the company has, which is frankly pretty much no debt for the most part. And the margins are also going up from where they used to be, slightly down, but still really high, as you'll see. And the net margins as well, much lower, obviously. These are the gross profit margins. And the operating margins and EBITDA margins on a similar trajectory, again, understandably, with return on assets, return on equity, return on capital employed, and invested capital all going up. And for a retailer, these are pretty solid numbers over here. All of these, frankly, are really good numbers. And if you're even seeing a price to book ratio here going down as well, which is typically more inflated when we're talking about companies that a lot of people buy, like public companies. And even though it's a retailer, right now it's getting crushed as well, which is good to see. It's better value. Now, if we take a look at the income statement of the company, you will see that they have been doing really well in terms of their numbers, like the total revenue from 2 billion back in 2016 to 11 right now. So they have been, getting a ton of new revenue coming in, which is nice to see. And even nicer, the fact that they are getting more net income from 260 million a few years ago to 1.7 billion. Very solid here, doing better and better. And so you may be thinking, okay, since this is doing so well, why is it going down so much? Why is it down 50%? Now, the main reason is that this has been a successful story for a while. They have been sort of like a trendy company. And the problem with these kinds of companies that are selling apparel, for instance, like Lululemon does, is that they don't have like a large moat, like they don't have something that it's tough to replicate. And so you have a new fashion coming out. So there is some new a company that is basically striving to replace them, and it's very easy to do. Like they don't have something like a competitive advantage other than the premium brand image and recognition right now, which okay, in the apparel space, you can never keep for too long. Now you will see here that they are getting some credit here. These are the tool actually shows us all the important events for the company that have been happening through the years, and also they acquired here another company. As you'll see, we also get that curious here products. Okay, the AI deep dive is what I like to take a look at now in order to understand the actual story. What is going on? Like we saw the numbers are very solid. So why is it going down? We can try to deduce that from the stories here and the quick takes that we see, the key stories, the quick takes, the Q&A analysis will tell us details about why this is happening. And as you'll see, they expect tariffs, which are a big thing here for Lululemon. They expect a massive $200 million hit, and this may not sound too much for a company like Apple, but remember the company is making 1.7 billion in net income, so this is pretty massive here. The tariffs are going to pack a punch, so this is important to know. Now, the $1 billion cash pile down 50% in 9 months. As you see, the reserves are plummeting, largely because management spent over 900 million buying back stock while fundamental risks were rising. And this is important here, and now I'm taking it to key investment stories. This is what I'm looking at right now, these key stories. We were here. So if you take a look at the key stories, this jumped here, this took us here. Buying back their own stock has left the piggy bank light. And so the amount of cash they have in the bank dropped by about a billion because, again, they bought back shares. And generally speaking, this is something that you like to see, but not so much potentially when the company has trouble with convincing people to buy the stock pretty much. So it's kind of a weird thing to see right now as they are as they're getting their stock price crashed. However, on the other hand, you could say that okay, this is a good opportunity for buying, which I understand and it is correct. But the problem is you may want to spend some cash actually on bettering your image, for example, or doing some marketing or something of that sort. Because this is a company that has a lot to do with fame and trends and all that, so it's important. And now they do have the company sitting on 2 billion worth of unsold clothes, by the way. That's 556 million more than they had last year. And China is the one big bright spot. We're going to talk about this a little bit later, but let's take a look at the quick takes first, because this gives us the stories basically in bullets here. And the US core this is very important. The US core is rotting. So same store sales is this comps drops 5%, meaning that the stores that they already had last year have dropped in terms of their revenue, in terms of their sales, 5%. This is extremely important because this is like North America. It's the biggest market that they have. And obviously, when the Wall Street is looking at such a lucrative market going down in terms of revenue, they get scared. And this is one of the most important reasons why this has been going down recently. And you'll see that decreased 2% in Q3, and comparable sales, this is same store sales, decreased 5%. Very important here. As you'll see, the practical investor takeaway is that monitor American same stores, pretty much, conversion and marketing return on investment, because this is obviously very important. And the bottom line is that there is demand weakness, which is material here. Very, very important, and it's something that has definitely scared investors out of the company here. And the thing that we said earlier is China, which is very important. So we have the situation right now where North America is not doing great, but on the other hand, China is doing really well. China is the one big bright spot. China is basically carrying the team right now, as sales there hit 465 million last quarter, up an impressive 46%. This is a lot in China, so China doing much better. Even better, people are shopping at existing stores more often, and the business there is becoming more profitable. And so you're looking at a situation where margins, sales are getting better in China, but worsening in the US. And generally speaking, the US market is obviously the biggest in the world, and so you don't like to see that so much, and there is fear because the stock has been elevated for a while, and right now, they are looking at sales going down, and this is why the stock has plummeted, while still being a pretty solid company in terms of their metrics here. All of these metrics have been going up and doing better for the most part, maybe apart from inventory, which we'll see. Even incremental margins are doing well right now. So the reason the stock has been going down is basically the future and not the present. So they are worried about what is coming for the company. Kind of understandably so, although 50% down is quite a lot for what the company is doing right now, at least. And you'll see the inventory bloat is the thing. Now, the inventory was good in terms of annual inventory, but the past quarter has been a problem because there has been higher inventory growth and lower revenue growth is what you are seeing here, basically signaling that there is unsold stuff pretty much going on. For the other part, for the most part, like the dilution is great, stock-based compensation is not a big deal. The company doesn't really have any issues with like bankruptcy and stuff of that sort. They have money, they're not cooking books and things of that sort. So again, it's a situation where we are actually monitoring what is going to be happening in the future. And us, as investors, we're potentially thinking, is this a buy right now? Is this a situation where I could put some money and let it grow? Generally speaking, I'm not a big fan of retailers. I have said that many times in my previous videos. I do like retailers like Costco, for example, obviously. It's a completely different story. But these retailers are mostly, like Lululemon, is mostly like what we call discretionary, like meaning we don't really need their clothes. while we do need to eat, so Costco is important. But something like Lululemon is discretionary, like we don't really need it, but we may want it. It's sort of like a prestige, nice looking clothes, good quality and stuff, so we pay the $100 for a piece of clothing, for example. And this is how this company is doing well. This is the core reason, which prompts for potential issues, because this cannot go forever for the most part, unless you are somebody like Apple, but it's completely different mode. It's not clothes, so it's as I said earlier, it's much harder to compete that hard in clothing, because one year's fashion becomes next year's outdated stuff, obsolete pretty much. Regardless of that, we can still take a look at the DCF, discounted cash flow, and you will see here how much this has dropped compared to its cash flows. So if I like to use the stock insights. This is a scenario that I have created myself, is the one that I typically use, but I have other ones. I have like more conservative, deep value, and you see the scenarios change here. So depending on what kind of investor you are, you want to try different types of scenarios. For the video's sake, I like to try this one, which is a little bit more, working towards the averages that the company does. Like the revenue growth here is going to be close to what the average of the company has been, 21%. So this is going to be factoring all that and designing a scenario where it's in between these revenue growths for the low, medium, and high. This is how I have created this one, with the margins also, again, being close to what the company has been doing historically here, which you can see about 13%. So this adjusts automatically and suggests the neighboring values with like a low, medium, and high, 14. And the required return, this is why it's called Lucky 13. I like to use 13% because, index funds, like the S&P 500 index fund, will give you 10%. So 13% is what you should ask for, 13% as a premium for investing in a single company. And if I calculate the intrinsic value here with a 5-year discounted free cash flow model, you will see here that we are sitting at a spot where this is undervalued in terms of the cash flows that it makes, meaning it can actually pay you back in terms of cash flows just by buying it today, at least for the medium scenario. And even the conservative is not that far. It's really not that far. So what you take out of this is that you're having a company that is doing really well in China, is not doing as well in America. The trends are kind of fading a little bit, and it has the price of the stock has actually decreased that much, like more than 50%, that it becomes an interesting potential buy, just because you are getting it at a price where low PE, low price to free cash flow, it's basically free cash flow as long as it continues this trajectory. And again, this is the concern. Can it continue, or it will keep going down? This is something that you kind of have to factor and talk about it with yourself, I suppose, if you are looking to invest in the company. But for me, I like this kind of, nice DCF model here. But I'm not a huge fan, again, of retailers of that sort, just because of two things. They are not a requirement for people, like they don't need to shop there, and also because of fashion getting, getting obsolete from one day to the next. So yeah, I'll probably avoid, but if you are looking to get a retailer, maybe this is one of the good ones to consider. Thanks for watching, guys. I'll see you in the next video. Bye.